Hello and welcome to this episode of the Property Forum Chat Show. We've got an exciting episode in store for you today. We're going to be talking property finance, the state of the property finance markets and mortgages. We're going to be covering all sorts of things like bridge loans, development loans, JV financing, which we use in our development business. So lots of good stuff to get your teeth into and to get a handle on what's happening in the current market today. So on today's show, as I say, we're going to be covering private finance. We're going to be covering how to get your property investment off the ground and talking to lenders how to, put yourself forward. We'll be looking at all sorts of different options, and we most importantly be doing a Q&A at the end. I will be answering, and Lucy will be answering, who's our special guest. Lucy Barrett from Vantage Finance is with us today. We will both be answering your questions from a development and an IFA point of view regarding finance and development. So without further ado, I shall introduce Lucy. Welcome to the show, Lucy Barrett of Vantage Finance. Thank you for joining us.
Hi everyone, and thanks for having me today, Nick. I'm looking forward to today's discussion, and hopefully we can answer a good number of your questions. So yeah, thank you very much and looking forward to it.
Not a problem at all. Looking forward to getting stuck into some of these questions. We've got a lot of questions. And just ever so quickly, for those of you that don't know me personally, just a quick introduction to myself, what I do. I'm a property investor, I'm a property developer. I've been doing property investing for 20 years now. We've built over £45 million worth of property. We still own around £30 million worth of property on our asset list that we run and manage, etc. And ultimately, property investment's been a part of my life for a long time, and my passion for that's run through into one of our main businesses, which is propertyforum.com, where you can go and get lots of free and cheap advice for helping you on your journey with property investing and finance. I've also written a couple of globally released books, namely the International Real Estate Investing book for Dummies. So Investing in International Real Estate for Dummies is the title. Well worth going and grabbing a copy of that off Amazon. It's not all about international property. It's not all about holiday homes, although there is a chapter about that. It's more importantly about HMOs, rent-to-rent, lease options, finance in particular. Obviously, we're covering all that today, JV finance. All sorts of things covered in that book. So it's a very cheap way to get a whole load of education that you might be paying thousands of pounds for some of these online courses. Obviously, leading on from that, I can also take people's education to the next level with mentorship packages they offer. And I'm keen to help anyone that wants to reach out and get going with that. So back to the important stuff. Actually, before we get going, sorry, I should mention our brilliant sponsor, Colour Reader. Really great gadget, this. We've had a crack on it ourselves, and it's a very good, this is where technology is now having a fantastic kind of effect on all industries. This is a gadget you can put on any wall. It's useful for landlords, it's useful for homeowners, it's useful for designers, architects to get the exact colour of the wall that you're working on in your development. So if you find a colour that you want to replicate, really great little tool. And they're our sponsor today. If you're interested at all, if you're here and you run a business and you're interested in sponsoring one of our chat shows, getting some coverage B2B throughout Property Forum, do reach out at propertyforum.com or ping me a message. Any of the normal communication channels apply, and we can help promote your business alongside ours. So, right, there's the intro done, and sorry to waffle on a bit there, Lucy. I think let's get stuck into some questions. And I think the first obvious question that a lot of people have been asking, and I will get to some specific questions that people have asked, through the pre-registration. And actually, as we're going now into the questions, anyone online, we are taking comments on the chat. Anyone watching on Facebook, YouTube, any of the channels where we're going live, we're going into some Facebook groups as well, on my own personal Facebook page. Wherever you're watching, post in the chats or the comments, and we will prioritise questions that come in live throughout the show. We might wait a few minutes for the right time. We will try and get to as many questions as we possibly can. I think there's over 100 people registered, and there'll probably be several hundred views on this video over the coming days. But please do post those questions, and that's critical. If you're online now, say hi in the comments. We'll give you a shout out. This is an interactive thing. Lucy and I are here. We want to, try and give you as much of our knowledge here as we can and answer those questions. And hopefully, help any, paralysis of like, we can't do anything because there's not enough finance, or we can't get our journey going because we don't know what we're doing. So we're here to try to give you the confidence, aren't we, Lucy, yes. about the markets.
Yeah.
So big question. tell us what you've seen in general coming into COVID. What happened? What's happening, and kind of where are things now in terms of things easing up a little bit? Just a general kind of comment, really, to start us off.
Yeah, so I suppose the first couple of weeks of lockdown was a bit scrambled. Everybody was running around. Lenders didn't really know where to pitch and change criteria. There was a big nervousness around what might happen over the coming weeks and months. We saw quite a short and sharp reaction following on from that, where lenders capped loan to values, withdrew product ranges, and just generally had a bit of a shift in appetite. And we probably saw that throughout the, 6 to 8 weeks following. Then as things started to ease up a little bit, there was just I suppose, more availability of products starting to seep back through. I think the initial fear that it could be really, really bad started to ease up. Everyone adjusted to how things were, kind of got their thoughts into line, got their thoughts processed, and it just generally felt that little bit easier. And the demand obviously slowed up, as did the availability of products. So whilst it was challenging, it wasn't impossible. We did a good number of transactions throughout the darkest point of lockdown, i.e. we had people coming to us with their inquiries at the start, that we managed to get properties valued and loans completed before the restrictions were eased. So I think, yes, it was quite challenging, but it certainly started to ease up towards the back end. And now as we've come out, there are definitely more products out there. I think lenders are still a little bit nervous when it comes to loan to values. We haven't seen a huge shift in loan to values. Some lenders have opened up a little bit, but then they've had quite heavy demand, and they've had to then retreat again because they can't manage the demand, because a lot of their competitors are still restricting their loan to values. So it's probably as you would expect, Nick. It's not easy, but at the same time, there are products out there. Lenders are lending. There is appetite to lend. We just have to navigate a slightly restricted criteria set, really.
And there was a lot of fallout with everyone giving the bounce back loans. Some lenders that were involved in that, payment holidays, all this kind of stuff, they got wrapped up just purely in admin, didn't they, for a couple of months there as well?
Yeah, that's a really good point, actually. Some of the lenders who we've worked really closely with for many, many years were actually in a state of paralysis because they had to move their front end operation into the back end just to be able to manage the calls on payment holidays. Banks, it's a lot easier. They do a self-certification process where people just phone up or submit something through the internet, and that's it, it's done. Whereas some lenders, they have to go through a check and a viability check on each request. And obviously that takes a huge amount of resource to be able to manage. So I think now that that's slowed down a little bit, it's given lenders the ability to redeploy staff back into the front end. And we've seen a bit more appetite coming through over the last few weeks, for sure.
Yeah, definitely. Little shout out for Simon O'Darmy. Thank you for saying hi, Simon. Anyone that's online, have a shout out. Looks like there's a chap, David, that might be David Massingham, looking to work together with the mentorship at the moment. He's saying the data color tool looks really useful for designers. Yeah, looks like a cracking tool. We've got a link just posted up here for that color reader if anyone's interested. Say hi in the chat. As we go through, I'm going to keep prompting you guys to post your questions. I want lots of live questions, lots of interactivity. That's what a live event's all about. You know, we can read out and go through the pre-registered questions, which we will do, and that will keep the conversation flowing. But your questions are key to this, and we're both here to try and answer your questions as best we can. So a question that's come in pre-recorded here, Lucy, is, I think you've already covered this one a little bit, but development, this is from Damien McLaughlin. Development finance providers seem to have retreated into the trenches with LTVs reducing to sub 60%. Should I wait for better rates around the corner or take what measly offerings are available now?
Thanks for that, Damien. So partially true what you say. We've definitely seen loan to value softening, and absolutely there are a number of lenders who have dropped to below 60% loan to value. There are still lenders that are doing 60 or 65 for the right transaction. Like with anything, it's really hard to give a blanket response to that, because it very much depends on the experience of the developer, the size and complexity of the scheme, the GDV of the scheme. There are too many variables to give you a one answer, but I think you can assume that most lenders have taken about 5% off of their maximum loan to GDVs. Some a little bit more, but there is still definitely funding out there at reasonable levels, albeit not quite as punchy as they were pre-COVID.
Okay, appreciate that. And what I'm seeing with, working with you obviously on a lot of our sites, and obviously just a bit of a background with Lucy and myself. I've worked with probably 20 brokers over the last 20 years, maybe not as many as 20, but certainly 10 to 15 brokers, and they've all been terrible, quite frankly. And we've worked with Lucy now for 3, 4 years, 5 years, something like that.
It really has been about that long.
Good few years now. And there's a good reason for that, because Lucy and her team are absolutely unbelievable. Many brokers will say, I can do you a buy to let, I can get that for you. I can get a higher loan to value, and they'll tease you in. But what's critical is understanding the lenders on a detailed level, on a deeper level, having direct personal contacts with each of the major lenders, really understanding what their criteria is, whether it's relation to HMOs or development finance. There's lots of subtleties on what development finance is. It's where is that development finance, and what is it? Are you developing an HMO? Are you developing a micro studio block, office to resi conversion, new build? Development finance is a broad brush, and the level of detail that Lucy goes into, and knows, will stop you making a mistake when you kind of go. And Lucy and her team, actually, all of her team are excellent. You know where the problem ahead of time, don't you, Lucy? And I'm sorry if you're getting embarrassed if I'm picking you up too much.
You make me blush. But there's no point in us just telling people what they want to hear. We sort of pride ourselves on being very honest up front, and Nick will tell you it's not always what you want to hear, but ultimately you need a really honest upfront appraisal so that you don't go chasing unicorns at the end of the day, because you can spend a lot of time getting led up the garden path,
and money.
Deliverability is key, isn't it?
Yeah, I mean, we've in the past I've had plenty of experiences of that where certain brokers have whacked in a quick application and it just falls flat on its face at the second or third hurdle, and it might be after evaluation. And a good example is one of the recent sites you've done for us, where we specifically needed the strength of the HMO conversion to be demonstrated to the lender. Where it wasn't just a quick tart-up job. There was substantial development, and it was specifically designed as an HMO and would be very expensive to put back to a single home again. And getting that across as a dedicated HMO was critical in the comments of the valuer, wasn't it? So your work speaking to that valuer was unbelievably detailed and essential to have got that deal through. Because if the valuer had commented on anything different or not supported it quite as much in the verbal, so it's not always about the number, is it? It's about the comments the valuer says in the valuation.
Yeah, absolutely. I think sometimes people overlook that. When you get a valuation report, it's quite easy to jump straight to the headline numbers. I do initially jump to the headline numbers, but actually,
everyone does that. But
you have to look within the detail, because it can be one tiny comment that could throw the whole thing out.
No, absolutely, completely. And that's where a normal broker won't go to that level. They won't understand valuations. They won't talk to the valuers ahead of time. They won't parcel and package all the right information to the valuers. So, there's good brokers and there's bad brokers, people. Lucy's absolutely one of the best brokers we've ever worked with. So if you need to get her to quote on your site, give you some advice, her and her team will help out. There's a thing popping across the bottom of the screen, which I highly recommend you log on to. Book a free call with Lucy if you want a quote for a mortgage, if you want to test out your existing broker, if you want to find a new deal, go and speak to Lucy. Ultimately, Lucy, next question, will buy-to-let deposits rise to more than 25% if property prices begin to fall? And that's from Elaine Liddell. Thank you, Elaine. Hi to Andrew Agnew, by the way, who's popped online. And hi to David Massingham. Yes, that is David. Other people, if you're on, say hi. Ask your questions online, guys. There's not enough coming through. I want your questions, please. Sorry, back answer, Lucy. Sorry, I'll do that a few times. You just have to sort of ignore me.
That's all right.
Let me do my rant.
So thank you for that, Elaine. I suppose the correlation between property prices and deposits, you can make the correlation on the basis that if lenders are nervous that property prices will fall, do they reduce the loan to values accordingly? And I think we've seen some of that, as I've alluded to in the last couple of questions that we've had. However, I don't think that there is a specific general direction that buy-to-let deposits will start to go up past 25%. There are some lenders who have certainly reduced their maximum loan to values because of their own appetite to risk. But I don't think as property prices fall, the deposits will increase. I think it's more just a case of lenders assessing where they think the market's going and pitching their loan to values for what's right for their business and their appetite for risk.
And I think, naturally the loan to value is built into the valuation. So if the valuation falls, they've still got the same percentage protection, haven't they? So
correct.
I think they've got that inherent kind of risk built in there.
The reduction that we've seen is where lenders feared that property prices would fall post-lockdown. Therefore, they reduced the loan to values because they didn't want to lend on pre-COVID levels and then find out that actually their loan to value turned out to be higher when we came through. Whereas now I would say it's probably starting to stabilise a little bit. And as you rightly point out, it will be based on today's values, and we're starting to see more transactions to get that data flowing. Whereas I think between mid-March and the end of lockdown, no one really knew how it was going to come through the other side because there were no transactions for purchases really. It had fallen through the floor.
No, that's really good advice, actually, and that makes it very clear to people that they only temporarily altered the loan to values just to compensate for the probably lack of market data from valuers in that COVID stage. So when the true values start to come out, they can readjust their loan to values again. That's really good advice, actually. That's very well explained. I never really thought of it like that, but that's exactly why it is. I'm going to whack on a couple of live questions just to show that we are watching you guys. Thank you to Miss Meng there. Thank you. She's asked, large HMO mortgage. Are many lenders coming back? What do you think is the lending prospect? Are the surveyors going to downvalue everything for at least 10%?
Okay. A few questions rolled into one there. So we've got the first question around large HMOs. There are actually still a good number of lenders who are offering those. I think some of the more hybrid mainstream specialist lenders, so a bit closer to the high street, they definitely retrenched from the large HMOs because they were pushing the boat out a bit into the more specialist market, which isn't really necessarily their core business, but they wanted to have a small offering in that space. And then you've got the more, I suppose, commercially focused lenders and challenger banks who haven't really dropped large HMO other than one or two. And actually, we have seen them re-enter. So there was a couple of lenders who reduced to maximum 6 beds, and they've come back out since with a 20-bed offering. So I think there is definitely still a market for that. The down valuation point is a slightly more complicated one, and as I understand it, the RICS guidance is very much a case that the material uncertainty clause should be added. So valuers should be saying we can only value it based on our opinion of today's market. However, we are in a very turbulent time, and therefore we cannot predict what's going to happen very easily over coming months.
I've seen that in a couple of our valuation reports, that sort of commenting.
Yeah, they shouldn't be trying to do a nominal discount. And I think RICS has really discouraged valuers from just applying a nominal discount, which I think is what you refer to with that 10%. Multi-unit blocks, so if you've got, rather than HMOs, but a block of, say, 10 flats, you often have a reduction in value to account for the single investment value rather than the added value of each flat put together. They'll look at it, if somebody was to come along and buy all of those 10 flats, what would they pay for those 10 flats is probably going to be less than what they would pay if you were to sell them to 10 individual buyers separately. So that's a different sort of deduction, but quite similar possibly to what you may have seen and experienced.
So like concentration risk, you mean?
Concentration, yeah, absolutely. Yeah. And I think with anything, you get the good, the bad and the ugly. And some surveyors are great. Some of them are really pragmatic and like to value things as they see it. Some go on a little bit of a protection of their PI cover. And I think you'll probably see that more now than ever through fear of valuations falling, I suppose, for valuers. They're unlikely to get into too much trouble for being on the side of caution versus being on the side of optimism. So valuations have always been a challenge in any point in the market, any time in the cycle. However, I suppose you're probably more likely to see that challenge increase slightly over the coming months.
Yeah, I mean, we had on one of our sites recently, we took the gamble to have a revaluation done. They downvalued it to 900,000, weren't prepared to budge. We got a revaluation done, got it valued at 1,075,000, so 175,000 more, which is a huge difference, isn't it? And that's just two different valuers' opinions.
Yeah, which is crazy, really, isn't it? Same property, a week apart.
Yeah, it's crazy. But that's the world we live in. It's always been a challenge with valuers to get the right valuer on board with your model, what you've done, the value you've created, the quality of your build. But the opinions do vary, and I think what's critical with any lending is understanding not just the lending and the products, but the valuation methods, the valuers, contact with the valuers, and that's what you provide, Lucy, is that level of detail that many mortgage brokers that I've never met do.
Yeah, you have to try and manage the process really as best as possible, don't you? And try and foresee what hurdles you may have thrown in your path.
Vicky's got a question here. Vicky Bogle, what's the appetite from lenders for commercial property? And are there any usage classifications which are easier to finance? So I guess we're talking sort of, well, I don't know what's the kind of, if you can post it in, Vicky, specifically what kind of commercial property? We're talking shops, we're talking offices, but a general question there, Lucy, to start off.
Yeah, so I can probably give a little bit of an overview over what lenders are favouring and not at the moment anyway. So retail has struggled for some time. Many lenders have had no interest in the retail space because of the challenges that it's faced for, well, a number of years now, a lot of businesses going online. Industrial units have certainly taken off, where you have more need for storage and online businesses that need warehouses, etc. So that's been a fairly optimistic sector and viewed well by lenders. Over the last 3 months, it has been a real challenge trying to get commercial lenders to have any faith in the income longevity of a lot of commercial buildings. So if you've got, say, a parade of shops with some flats above, and you might have a hairdresser, you might have a coffee shop, whatever it is, there's a whole host of different sectors, especially in the leisure and hospitality, where it's obvious that they will have had zero income because they haven't been able to open. Obviously, lenders have been nervous over what the potential failure rate could be, and therefore not keen to take any value in that commercial income because they could lend on it based on a 5 or 10-year lease. The tenant stops paying, they're unable to meet their commitments, perhaps the business goes into liquidation, and the landlord is left with a parade of shops which are all vacant, and there'll probably be a reasonable supply versus the demand, just given what's going on in the wider economy. So I think the first thing to do is to look at the underlying tenancy and how likely that business is to withstand the current economical troubles, if you like. And it's then really just applying that reasonability test to it and seeing whether it's something that we can make a good argument for before we put it forward to any lender.
Okay, really, really good answer. Thank you. Very full, and obviously huge amount to consider. Again, the devil's in the detail with this kind of stuff, and it's being fully prepared, preparing your case, picking the lender, that is prepared to work with you on that. Vicky said, if it's a vacant shop, what if it's a vacant shop?
Okay, so vacant shops are a little bit more challenging because if you're looking at a true commercial mortgage, and a misconception is often that you look at the value of the property and what you want to borrow against it. But when it comes to an income producing asset, what lenders are looking at is how you will be servicing the debt. So if your monthly payment is £2,000 a month and you've got zero rent coming in, they're going to say, well, hold on a minute, how do you plan on paying that mortgage? So if you are buying something with a view to develop it, that's slightly different because we're getting into different products. Maybe it's development finance, or maybe it's a short-term bridging loan just to make the purchase whilst you work the planning. But if you want a true commercial mortgage, if it's vacant, we need to look at how you plan to service that and find a lender who will accept that source of serviceability. And usually just having the money in the bank isn't good enough because you could go and spend that money on something else. So they want to see an income stream that can cover the debt for the period of the loan that you take.
Okay, so they want to see from the investor that they've got enough funds to cover it in their personal background. If it stayed vacant forever, they wouldn't consider a potential future lease. You know, if it's a highly leasable town centre shop, they're not going to give you like a 6-month buffer where you need to cover it. But then, you know, you're going to get a lease.
Unfortunately not. There should be a product out there where they perhaps retain some of the payments to give you time to rent it out. I think it was probably easier to find products like that pre-COVID, whereas now lenders very much want to see the income and they want to see that that income is likely to be able to survive over the next 6 months or however long this goes on for. So you would probably be looking at a short-term bridging loan until you got the income in place.
Yeah, get the lease and then refinance.
Exactly.
Two-phase. Yeah. Okay, that's great. We've had a question coming from one of the Facebook groups, London UK Commercial Property Investors Facebook group. Thanks for watching on there, guys. Any more questions from there, fire them in. Adarian, I've gone bad with names. Ilasami has asked, would the coronavirus pandemic roll back the phased implementation of Section 24? It's not really a mortgage question, is it? But do you have any opinions on that, Lucy?
No, not really. I don't think that's going to be something that is COVID related. I don't know whether you've got any further thoughts on it, Nick, but like you say, it's not really a mortgage one.
It's not really a mortgage question, that is it. But, you know, I think there's lots changing at the moment, isn't there, with all the stamp duty holidays and stamp duty things. And even for investors, you can get the main bulk of the stamp duty off. We still have to pay that 3% surcharge as a second home or investment home up to £500,000 purchase prices. So that was great news for property investors and home buyers alike. Hopefully that will kickstart the market. But Section 24, I personally don't see that being rolled back anytime soon. That would be a big crawlback. Plus, you know, there are ways to mitigate it anyway as an investor. So I think you just need to be on the right tyres at the right time. My famous saying, I'm an F1 fan, so Formula One, you've got to be on the right tyres at the right time. You know, don't go out in the wet on your slicks. And if the market changes, implement a strategy, implement a structure that works now, and don't second guess the market. Right, let's get back to some pre-asked questions. There are lots of live questions coming in. Please keep your questions coming in, guys. Really important that you are part of this show. We really want to hear your thoughts. We're here to help you. So keep the questions coming. Don't forget to subscribe if you're watching and you're not subscribed to our channel. Please do subscribe to the YouTube channel. Obviously, the usual links below. Click the little bell icon and subscribe to Property Forum TV. Please send it to all your friends, your mates, your Facebook groups. We do at least every other week podcasts and other various content that we pop out here. It's all educational, it's all free, and it's all here to try and help you guys navigate the complicated world of property investing. So yeah, once you've subscribed, you'll get notifications each time we go live as well, which will be useful. So the negative interest rates, what are your thoughts there? Ant Pridden is asking, do you think that will be a reality? Will mortgage valuations be lowered significantly? Who knows?
Yeah, so negative interest rates, I can't see it, but stranger things have happened.
I can't see that.
I think there have been many occasions where I found myself saying that will never happen. So never say never. But personally, I can't see it. mortgage valuations, I think we've covered a little bit anyway, so I won't go into any more detail on that, but perhaps you've got some thoughts, Nick.
Yeah, I mean, for me, I can't see that happening. I think it would just be too much of a different market, the unprecedented market, like we've been saying all through COVID. I think if you start going into negative interest rate, that unprecedented climate's going to add to the problem, not help it with just adjusting interest rates. That's my opinion. So yeah, hopefully, we just want a stable market. I mean, I think all the stuff the government's done, the government have done a cracking job, I have to say. That's my opinion.
They've thrown and sink at it, haven't they?
Oh, they've thrown everything at it, and they needed to. But that's good for property investors who have real assets and bricks and mortar investments that, with the government printing all this money and inflating the pound, we're all going to be making good asset capital growth, aren't we, hopefully, with massive inflation over the next few years. Right, let's go to some questions. We've got some more good questions coming in. We've got one here from Mr. Patel, who is asking, some lenders do not lend on leasehold flats where the ground rent is doubling every 10 years. Are there any lenders accepting this? It's a very, very niche question there. That's going to test you, isn't it, Lucy?
Funnily enough, it's not the first time we've been asked it. We've had a few of these recently, and they are very, very difficult to place. Very difficult to place. Right. To my knowledge, we haven't managed to. But I'd probably have to take that one away and double check it that there hasn't been any that have come through since that we've managed to have success with. But all of the usual suspects will not accept that.
Okay, well, so if you want to sense check Mr. Patel, reach out to Lucy. She can see what's happening at the moment. I think in the current climate, it's probably less likely, isn't it? These kind of slightly niche products that are a bit more risky tend to be the ones that go first in a tricky market, aren't they?
Yeah, I think the issue is resaleability. So it would put some people off from buying it, and therefore no lender wants to be in a situation where they've lent on something which has got a limited pool of buyers in the event that they had to repossess. That obviously makes it harder to sell. So
yeah, okay. We're dotting all over these kind of questions, but I want to pull it back to a topic I want to cover, which is how to present your property investment projects to lenders. And that's both high street lenders and private finance. And I'll cover a bit about private finance and how we work with private investors shortly. But in terms of the sort of high street lending, Lucy, what sort of information should applicants be kind of preparing, be ready for? What are they being asked for at the moment? And what's your sort of experience of what those lenders are really taking seriously at the moment? I know we did an application for a straightforward buy-to-let on a house, didn't we, this month? And they were asking me for my entire cash flow for the entire business. That's like 15 limited companies and over £2 million worth of yearly rent. You can imagine doing across all the different entities. They wanted a cash flow sheet, and then they wanted a business plan forecast as well. And it's like, that was for a 250 grand mortgage. So it's quite unbelievable, some of the things they're asking. But what should applicants be ready with, I guess, for these applications currently?
The situation that you're describing there is a buy-to-let for a portfolio landlord, which is what you are. So 4 or more mortgaged properties, the banks have to ask additional due diligence questions around business plans, forecasts, cash flows. So different lenders take that to different extremes as well. I think those who are a little bit more sausage factory, more of a commoditized buy-to-let product, they will just have standardized forms. They won't try and piece it together themselves. They'll want you to kind of do all of the form filling, and it can be pretty painful. But I suppose the question's a really good question generally, just around how to present things. And we see different types of people and different ways of kind of pulling together their paperwork. So you have to look initially at, I suppose, 3 things. So you've got the property, the person, and the income. The income is less relevant if you're not doing it as a longer term hold. So I touched on that a minute ago around short-term finance and development finance. Clearly you are doing that for a short period of time, and the end goal is either to sell or refinance at the end, at which point the income question comes in. If you're looking at a buy-to-let or a commercial investment or a HMO, something like that, then they're going to start by looking at the property. So what's it worth? Does it have all of its licenses? Does it have its building regs, its planning? What planning class is it? Making sure that you understand all of that and you've got all of the questions, all of the answers to the questions that you might be asked on hand. A lot of the time we talk to people and they're not entirely sure about certain regulations or things. They say, oh, I'm sure that's been dealt with. And the number of times we get down the line and it hasn't been dealt with is quite remarkable. So always understand the planning, building regs, licenses, etc.
And I think if I can just quickly cut in there, I think that's really important, working with a good power team. And when I'm mentoring my clients, I'm often referring them to you, aren't I, Lucy? Because you're the one that I trust, that I know has got this experience. And between the two of us, whether it's the mentoring side and the business side, getting someone's knowledge up to speed so that they know these kind of things, so that they can answer them and not be caught out by going straight to a lender with a inferior broker and not presenting the information correctly. This presentation and understanding of their business and presentation of it is absolutely critical, isn't it?
Yeah, absolutely. And we will ask quite a lot of questions when we speak to somebody in the first instant. And some people are great with that and they're happy to answer as many questions as we can throw at them. Whereas some people, they're just not as happy to be in the detail for one reason or another. But it's so important, because all that will happen is we will quote something, we will get a lender on board, and it will fall over because there'll be a piece of the puzzle that we didn't know about. When it comes to you and kind of assessing the customer, we need to have a look at your experience. So a lot of lenders will have experience requirements. They may say that if they're going to lend to you on a HMO property, they want you to have a minimum of, say, 2 normal buy-to-lets if it's your first HMO. So some of them won't do first-time HMO landlord.
Okay. Yep.
Same with commercial investment. Sometimes they'll want to see that you've got a certain number of other property investments before they'll allow you to move on into a commercial product. Okay. Development experience as well, if you're refurbishing something or developing it. If you're, let's say for instance, you've done up your own home that you live in, and then you want to go and develop a 10-unit, £5 million GDV scheme, they're going to say, well, hold on, that's quite a big stretch between the two. So it's really important we know about everything that somebody's done and what experience that they have, so that we can present a stronger case as possible, or perhaps be honest with you and say this isn't realistic, that you'll be able to obtain funding on it. So the customer piece, I suppose, is your assets and liabilities. That's always a big one. Talking about what you own in the background, the values, when you bought it, what mortgages you've got outstanding, as much detail really as you can pull together. If it's in spreadsheet form, that really helps us, because it means that we're not trying to scrabble all of the information together. So be organised with that, kind of do it. I think, Nick, you'll probably second this. Having it all there helps you anyway, because you can revisit it if you need to check something, keep it updated all of the time. So if you've added value to something, make a note of that in the spreadsheet, because otherwise you might send it to us and we'll put that it's worth 500, but actually you went and spent 100 on it 3 months ago and it's now worth more. But then that looks worse to the lender, because it looks like your loan to value is higher than it is. So yeah, I think making sure that your information's up to date on all of your assets and liabilities is a really big one.
And that's good practice anyway, isn't it? Because you want to know what you own, you want to know what you're worth, what your net worth is. That calculates your net worth, essentially, an asset and liability sheet, and it also gives you a goal, kind of what to work towards. And I've got, I say when we do the mentoring, I've got all these sheets and stuff. I can provide you templates. I'm sure Lucy's got templates as well, haven't you, for certain lenders that you can create those spreadsheets. So, if you're getting into investing, you're looking at your first buy-to-let and you need guidance, reach out to either myself for some mentorship or Lucy for some mortgage advice, getting a mortgage in principle, an idea of what you can lend. Then between that kind of that education and that those facts of what you can get out, what you can lend on your first deal, you'll be well equipped to go and source it. That's critical. So jump on propertyforum.com/property finance at the bottom of the page there. Get a call booked in with Lucy or one of her team, and she will be able to help you. So a couple of questions coming in now. Let's get to some of these, which are quite good, actually. Andrew Agnew, thank you so much, sir, for posting a question for us. Andrew asks, presumably development finance will become more widely available and affordable if Bojo's build incentive, I presume you mean Boris Johnson there, Bojo, that's a good one, I haven't heard that before. If Bojo's build incentive translates into more flexible and fast-tracked planning. So is more development finance, will it become more widely available? Firstly, what a great opportunity that is, isn't it? For all us property investors out there. You know, we've got a big site in Newbury that you're refinancing for us will shortly be refinancing for us, Lucy. 6 million plus sites, but we could get another 2 stories, it's rumoured, on this building, which would add another couple of million to the GDV, which would be a very nice Christmas indeed. So all sorts of interesting PD rights and shops. There's a couple of questions I see here about shops and lending for that. We'll get on to into a minute. But development finance, you know, is this going to help it? PD rights coming in, extended PD rights.
I'm not sure that it will actually directly link, because you've got usually your planning in place when you take development finance anyway. So I'm not sure having easier access to planning or doing something under PD wouldn't necessarily mean that you can get the finance easier. I suppose it could grow the development finance market because more people are doing it, because the planning process is easier. So probably the size of the development finance market will increase, but I don't think that
that will ripple onto the availability, I guess, won't it? If the size increases, then that might affect the availability.
Well, it could mean that there's more lenders playing in that space.
Okay,
perhaps.
A bit more competition.
I don't think it makes development finance easier or harder to obtain, because ultimately development finance is assessed on the scheme and how solid that scheme is. So they're looking at what the GDV is. Obviously, they'll do their valuations to make sure that that all stacks up, what you've got to spend, making sure that the profit level is right in the deal. So whether you got planning through PD or the normal channel probably doesn't really impact that. But yeah, I think if we were to look at it a little bit wider than that, you could say that the market will grow as opportunities increase for developers to do more without having to go through the laborious planning application on everything.
Yeah, no, absolutely. I'm excited to see what happens anyway, certainly. And what have we got here? Picking out some good questions here. Oh, David Milner. Hi, David. Nice to have you on. Hi, guys. If you have an income where a proportion is sent direct to a SaaS, is this generally considered as income still or wiped out?
It depends for what product. If you were looking at it for a residential mortgage, that wouldn't be something that a lender would take into consideration, because they'd look at really your pension income in retirement. So if you're not at retirement age and you can't draw that income back out, it's not readily available. They're looking at the income that's coming through your bank account now. When it comes to commercial buy-to-let development, it's normally assessed on the property income rather than your income anyway. Lenders will look at that. They want you to have an income in the background. They don't really like it where buy-to-let income, you've got one property and that is your only source of income, because once you've mortgaged it, then technically that income is no longer available for you to pay all your bills and do all the things that you did with it before, because you're paying the mortgage. But really, the only way, I suppose, that it would come into play is if you're looking at a residential mortgage and you want to take it into account for that basis, and in which case, no, lenders wouldn't normally if you're not drawing it.
Okay, thank you for that. David has asked, David Massingham, how easy is it to gain finance for conversion from retail to residential, given the potential for failure for small retail units currently and assuming planning is in place? So there is talk of this PD allowing certain shops to be converted under PD. Obviously, there'll be restraints and restrictions to that, as there always is. But this could be a new product, or very, almost a mainstream product, couldn't it, Lucy? Sorry, for the next couple of years.
So I suppose it's fairly similar to the office to resi
Okay, yeah.
And Nick, I know you've got a lot of experience in that space, and
Yeah.
there's certainly a number of options available, whether it be pure development finance or perhaps more of a bridging short-term refurb product. And the difference between the two is that bridging tends to be based more on current value, and development looks at the GDV. So you draw down against cost for development finance, whereas for bridging refurb finance, you borrow purely against the value of the property at any one time. But there are actually a lot of products in the market for change of use, whether it be from office to resi, commercial to resi. So I think that is an area which is probably quite well served and will continue to be. And it would probably slot in somewhere akin to the office to resi PD schemes.
Okay, so good opportunity then. Plenty of lending should be there without too much difficulty, hopefully.
Yeah,
so it's all about getting the deals now, isn't it? Okay, that sounds good. Got a question, one of the pre-answered ones on this kind of general topic of presenting your project to the lenders. Lionel Palatine has asked, how should property company accounts be written up to enable the best lending opportunities available in the current market? So, I've got lots of experience of this, but you never know with a lender specifically. They look at the balance sheet, they look at the asset value of that company, they look at the income, they look at the debt you're servicing, all that general company account stuff. You obviously want it to be a profitable company, I presume, don't you, Lucy?
Yeah, so thanks for that, Lionel. I think, again, it comes down to what product you're looking at. So I'll answer in a fairly general way. If you're looking at it to service the debt, i.e. you are buying a commercial property for your business to occupy, they will look at the affordability in your accounts. So we have a lot of people that say, well, I've kept the profit low because I haven't needed to borrow, and we want to keep our tax bill down, so we haven't done much with the company and therefore it doesn't show a great profit. That makes it obviously quite hard to borrow against, because as I alluded to earlier, lenders look at the income levels coming through and they will apply their own stress tests to make sure that you can afford the mortgage both today and in a situation where interest rates were to increase, which is all very likely. If you're to take a 20-year term, there's a very strong chance that throughout that term the interest rate will increase unless you've taken a fixed for a period of time. If you're looking at something which is more development finance, bridging finance related, and you're borrowing in a property company, so you've got an SPV, or perhaps it's one that you use for your main trading for all of your properties, what they will want to see is that you haven't got any big red flags in there. So like you alluded to on the balance sheet, they would want to make sure that the company is solvent, that it doesn't look like it's going through any financial issues. I don't think you have to present accounts, really. They should just portray a true picture of what you're doing. And okay, many property companies that buy and sell and develop will go through a period where their accounts might show a loss because all they've done is spent money in a year, because they've bought a number of sites, they've done lots of development, but they didn't sell anything within that 12-month period. And then perhaps the next year all the sales come through. So you could kind of go from famine to feast, or vice versa.
It's just explaining that journey, isn't it, to the lender?
That's it. Yeah, as long as you can tell us why it's happened and it all makes sense, I think that's the main thing, really. But like I say, if we're relying on the income from that business, it's a different story. We have to look at actually the profit that you've made, and any add backs like your rent we can add back, tax and depreciation, to evidence that serviceability can be met throughout the term of the loan.
Okay. I've got a question here from Laniana Telitawa. What sort of loan is applicable for serviced accommodation? First time buyer and would like to get the best interest offer for the loan. That sounds like a tricky loan to get. Serviced accommodation, first time buyer. Doesn't tend to go very well together. What are your thoughts, Lucy?
Yeah, you hit the nail on the head there. You beat me to it. So my point about experience with serviced accommodation, lenders will look at that as a product that they would want to see somebody with experience of running serviced accommodation, because it has a much kind of higher you've got more management, I suppose, of serviced accommodation. Whereas if you've got a buy-to-let property, you'll have an AST, maybe you've got an agent that helps you find a tenant and look after the property. Whereas with serviced accommodation, you've got a higher turnover of people, you've got more maintenance, you've got higher costs. So I think the reality is you probably want to just take a step back there. Although it's a great income opportunity, sometimes you have to be realistic about what is available in the market and what you can and can't do. So perhaps looking at doing the journey from buy to let through to HMO through to serviced apartments would be a more sensible journey. I generally, if you're trying to do something that's really difficult, if it can be funded, then you just will not get a good interest rate. So if we were able to help you, it would probably cost quite a lot for you to do it.
Yeah, and I think another option for that person is for Laniana, sorry, is to maybe do a rent to rent on serviced accommodation. That's another property investment strategy. It doesn't get into the mortgage market, unfortunately, Lucy, but it does get someone going in serviced accommodation if they want to rent a building and then sublet the rooms, obviously with all the caveats. I've got a whole chapter on rent to rent in my book, Investing in International Real Estate for Dummies, available on Amazon. And that goes into quite a lot of detail, and you'll sort of see how you can do it. We cover rent to rent, we actually cover serviced accommodation, 2 different chapters there. So that could be another way of getting into that, Laniana, rather than necessarily having to buy it in the first instance. Then when you run a few rent to rent and you've proven yourself as an operator, that might actually open up the lending, could it, Lucy? When you've got the experience of running it, maybe, but haven't owned one, would that help?
Yeah, it would certainly give you.
It's not going to harm, is it?
It gives you points. It doesn't fully cover the problem, but it definitely would help. And then, really, I think if you had that experience, and then we could look a little bit further and look at what other things you have done in the past, what your asset profile is like. So when a lender looks at what your personal guarantee is, making sure that actually your net worth can cover the personal guarantee and things like that, they all help. But it's a tricky one.
Yeah, no, it certainly is. What have we got here? Got some more questions coming in. I want to pick some good ones that are a bit different. I'm trying to vary up here. Keep the questions coming in, guys, as well. There's a few I've got to get to here, which I will do, and keep them coming in. Just say hi if you want, so we know you're listening. We've got a good few viewers online at the moment. I think we're over 60 current people online, so we'll be getting lots of views on this video. Please share it and chuck your questions in, and subscribe to the channel so you get notified each time we go live. Every other week, we try and do it every other Thursday at 12 o'clock. So Adam Howarth has asked, what financial products are available for multi-unit buy-to-let, and what rates are we likely to expect? I'm looking to undertake a commercial conversion of some offices into 5 apartments. So it's an office to resi conversion, very similar to what we do.
Yeah.
We do micro studios generally to really maximize the asset. Maybe worth reaching out, Adam, if I can show you our model, do a mentor session, because actually I'd be interested to see if I can maximize your GDV on that opportunity. I might not be able to, you might not be interested, but might be worth exploring an option. But what's the sort of finance products like at the moment for that, Lucy, in rough kind of numbers can they expect?
So
I must stress as well, sorry to interrupt, must stress, Lucy and I, neither of us, especially me, are not giving any financial advice today. This is book the call for the financial advice, independent financial advice. You will get it from Lucy and her team officially. This is generalistic advice today. So yeah, I'll let you carry on, Lucy. Just wanted to make sure we didn't get sued there before we give exact numbers.
Yeah, quite right. I think the challenge with these things is we can only really be general because every circumstance is so different. So so you start by saying 5 units. So that's quite good, because that actually probably has the widest range of options available. When you get into 6 or more units, that starts to become a bit more challenging. Still absolutely doable with a number of lenders, but the pool of lenders shrinks a little bit the more units that you've got, because then you get into the higher concentration risk, higher management costs, which is all fine provided you can demonstrate that you've got the experience and the know-how to manage it.
I like to challenge you with our 42 unit scheme in Newbury.
I know. You've given us a few of those, haven't you? Curveball. So in 5 units, actually 5 unit multi-unit freehold block, there's quite a lot of products out there for that at the moment, and some lenders are at 65%, but there are also some that will do 75. You can probably borrow somewhere between, call it, it depends whether you're buying individual, limited company, but just to be very general, 3.75 to 4.5 is probably a really good ballpark for somebody looking to
anything
do
under 4 would be really good, wouldn't it?
Yeah. So yeah, lots of options for that type of scheme.
Okay, I've got Ben Green asking, how do lenders view co-living projects, specifically for development finance and then refinancing a stabilised operational asset? So development finance and term loan.
Okay, yeah. So there are some lenders who have quite niche products offering that. I suppose I've not seen so much in the co-living space over recent weeks and months, and I'm not sure how that would be viewed at the moment, because I think people are starting to look at how the market has behaved and what products people might want as a result of what's happened over the last few months. But there are certainly products for both out there for that type of project. You get more into the commercial space then, so that 375 disappears and you get more into the kind of 4.5, maybe even 5s for the term finance. There are development lenders who will offer dev funding on that type of thing as well. So it's certainly a market that's open.
Okay, excellent stuff. Got one here from Mark Watson, which you might better help with, Lucy. Oh, got a problem with a few comments up on screen here. Mark Watson is asking, on the rent-a-room scheme, you can have 7,500 tax-free. However, why is it lenders don't seem to recognise this, or do some take this into consideration? It's not something I'm familiar with.
So I think what you're asking is where you're looking at a residential mortgage and you could rent a room and receive that income, I think. So if I've got that right, I will do my best.
That sounds right, yeah. No, you're right, that rings a bell to me too, but double check it on Google.
If I'm honest, I've not seen a huge demand for that type of product, so I'm probably not that well placed to answer it really. I could have a go and say that it's a more flexible type of tenancy. I don't know whether you would have a formal AST in place or whether it's more of an informal agreement, and therefore if you changed your mind and decided not to rent the room out anymore, they've lent you money based on income which wouldn't necessarily be featured moving forward. It may be that you get sick of renting a room out and you decide not to anymore, and the loan becomes unaffordable. That would be a guess, but like I say, it's not really something that I've had great experience of. So
I think you could do either there, Lucy. I mean, AST would be fine. Again, if it was just a tenancy at will, almost like a guest house or an Airbnb set up, you could get someone out within 24 hours if you had that sort of setup. So it's up, I guess it's personal choice. Or if a lender would recognise it, maybe an AST is better.
Yeah, I think lenders, when it comes to residential mortgages, they're a little bit less flexible at what they'll look at. So I think even if it was an AST, they would just be nervous around the whole setup in case you decided you didn't want to do that moving forward, and they've lent you money based on an income stream that then you change your mind about moving forward, because you may not want to keep someone living in one of your spare rooms for the foreseeable future. So the mainstream residential mortgage market is a lot tougher because they have the kind of norms of what they expect from income, and anything outside of that reduces the number of lenders available. But there could well be lenders that do recognise it. It's not something that I've personally come across.
Not that common. That's actually how I started out in property, Lucy. Started off renting out my spare room.
Did you?
Then rented out another spare room, then another. And then I converted my, yeah, well, absolutely. Then I converted my integral garage to another ensuite room. And then I moved out and rented my old room, bought another house and did the same again. That was how I got started in my first house. I was doing HMOs in when I left university in 2000. Yeah, 2000. 20 years I've been investing now.
Not quite as heavily regulated then as well, I would imagine.
Yeah, not as regulated at all. I mean, yeah, it was quite easy.
Yeah,
it was good fun. And yeah, Adam's just asking, Nicholas, how do I book a call with you and Lucy? Go onto the website below, propertyforum.com/property finance. You can book a call with Lucy there. Those details will come through to us as well. Got tongue-tied there. And Lucy and one of her team will get your details, give you a call, drop you an email, and talk to you about any options regarding finance that you're interested in. I also do the mentorship, so I'm mentoring lots of clients. Well, not lots of clients. A limited number of clients actually, not lots at all, because my main job is developing properties, as you might imagine. So ultimately, my time is fairly limited, but I do take on a kind of up to 10 mentors and mentees at any one time. I've got a couple of slots left at the moment. So if anyone's looking for some mentorship, we book packages generally of sort of 5 sessions at a time. We go through everything from, finance we talk about from a business sense, and then I'd pass you over to Lucy for more specific applications. We talk about HMOs, we talk about service accommodation, anything you want strategy-wise, all the different strategies we can cover. Most importantly, I do things like office to resi conversions. I talk about company structure. I talk around the topic of tax, although I'm not an accountant or tax advisor. I pass you then on to a trusted advisor, part of my dream team for that as well. So yeah, if you're interested in any sort of mentoring, Adam was talking about his scheme there of an office to resi conversion to 5 flats. I'd be very interested to see that and see how we might be able to lay that out and see if there was a way of increasing the GDV, because when you start to do those kind of conversions, Lucy, they're very much valued on the investment value, aren't they, at the end of the day? So the more income you can create, the higher it's going to get valued, in theory. There are caveats to that, of course, like substantial development.
Yeah, and it's finding the lender to lend off of the investment value, because you've got 2 ways of looking at it, but we can overcome those sorts of things.
We can overcome those. We've overcome one of those this week successfully, touch wood. Although the money's not hit the account yet, but fingers crossed. But yeah, certainly we can help with all those kind of things. So reach out to Lucy on the link below. Let's have some comments coming in. I'm getting less comments now, so I'm going to revert to the pre-ordered ones. Come on, guys, send me more questions. We want to help you guys out. Just say hi. What have we got here? So how's it best to finance a mixed commercial and residential property? It's a good question.
I suppose depends.
That's from Adrian, by the way. Adrian Alderton.
Thank you for that one. So if you're looking at it as a sort of long-term investment, then you'd probably be looking at either one of the high street commercial lenders or challenger banks. The high street commercial lenders are not particularly generous with their loan to values, and they always want repayment rather than interest only, which can make the cash flow quite expensive. You would be looking at really probably 55 to 60% on the high street, whereas with the challenger banks, you could probably get 75% on a purchase. So there are plenty of products out there for that type of product, and it all just depends on number of units, what type of income, who your tenants are, that kind of thing, tenant profile. If it was something that you needed to refurbish, then we'd be looking at something more short term, depending on the spend. If it's not that big a spend, we'd probably do it on bridging finance. If you needed to do a big conversion, then we'd be looking maybe more down the development finance route. But there are plenty of products out there today, and have been for quite some time, for mixed use products.
Okay, excellent. So not too tricky at all. I'd like to move the discussion now, if I may, a little bit onto the area of private finance. And I know a lot of you would have registered for this podcast, and this, whether you're listening online to the audio versions, or if you're watching it on YouTube, one of the Facebook groups, you would have registered to understand a little bit more about private finance. I'm going to be able to, talk. I'll probably take a bit of the lead on some of these questions, but I'd love to hear Lucy's view on some of it. And it's, how do you, lend money to someone, as like a developer, and if you're a developer or investor, how do you present yourself and as a viable investment for someone to lend to you? There's two sides to that coin. I'm sure there'll be people watching that are interested in lending to viable investment partners. And there will be people out there that need to learn how to scale their business by taking private lending. And private lending, more often than not, is a top-up or an additional product to the traditional the traditional schemes out there that Lucy's dealing with in mortgages, bridge loans, development finance. And I'll go into our red brick structure shortly to show you what we do and how we take lending from private investors and give them an excellent rate of return. So ultimately, where do we start with this, Lucy? Tell me, have you got many other clients that have got private finance in the background? You know how we work.
Yeah.
And I'll go on to our structure in a moment. Have you got other clients that use this? And what's your experience of the private lending in sort of areas? I know it's not your speciality, but
no,
what's your experience?
We do see a lot in different ways, shapes and forms. So the way that you guys do it is very professional and structured, but you get variations of that. So some people will take equity. It may well be that they'll set up a new SPV. They'll take equity from somebody who isn't going to be involved at the front end, but will have a financial stake in the development, and they will be a shareholder in the business, but they won't be hands-on. It may be that they do it by way of a side agreement rather than actually being named on the company. Lenders often want to see developers have a minimum amount of their own cash in the deal as well.
Skin in the game.
Skin in the game, that's the one.
I hate that phrase. I hate it when lenders want skin in the game. I want to do no money down deals or no money left in deals.
They want to see you have as much left in there as possible.
Absolutely.
So there's a few different ways of doing it. I think it's really important that the other one is the kind of crowdfunding peer-to-peer type thing. And it's really, really important that if you are going to lend money, that you are doing it into a professional arrangement, because lending money isn't for the faint-hearted. You shouldn't just go out there and start handing out money without having done a really good level of due diligence and being confident in the partners that you're investing with. I think a lot of people see money lending as an easy way to make a good return, which it absolutely can be. But it can also go wrong, can't it, Nick? I think we've seen the peer-to-peer vehicles run into trouble over recent times, and that kind of highlights how important it is to understand what you're doing and have your downside protected. So I'm sure Nick will have lots of advice on that, but my takeaway is just to be very, very mindful of who you're doing it with before you go lending money.
Oh no, absolutely concur with that 100%. And it's about due diligence of the developer and the people running the schemes. I see a lot of schemes out there with very nice glossy brochures. They look fantastic, and ultimately you've got to really look at the people behind it. What they're doing, what their track record is, what their experience is. Are they capable of running this stuff? Have they built up gradually and over a good amount of time? Are they ethical? Go down and meet people that you're considering investing in and see what they've done. Ask to see their previous sites. If anyone's interested in investing with us, I'll take you around every one of the sites we've ever built, even the ones we've sold. I probably can't get into half of them, but I can show you them from the outside. I can show you the figures. We've built over £45 million worth of property now, and we still retain about £30 million in our portfolio. So we can show you around a lot of sites like that. And thank you, Bill. Bill's online, one of my mentees. Cracking chap. We've done our first session last week, and these guys are cracking along. And I actually gave them a tour of one of our large sites, the Newbury one, the 42-unit scheme. And I think it's always good to see that kind of stuff being done, and the spec and the design and all this kind of stuff. So get to know the developers or people you're investing in, the schemes they're getting invested in. I do get worried when I see these sort of certain crowdfunding platforms. There are some very good ones out there, by the way. Crowdlords is one of the very good ones out there. Richard Bush of Crowdlords, fantastic chap, speaks with me on the Property Summits events, actually. So we've got a Property Summits webinar next Wednesday at 12 o'clock. That will be live aired on the Property Summits YouTube channel and the Property Forum TV YouTube channel. Well worth getting in on that. Lots of good lots of good speakers, I should say. So jump onto that as well. But I get worried with some of the other lenders out there that got the schemes, and you look at the schemes and you're sort of like, wow, they're putting their name to that for investors that are blindly investing into it. That concerns me sometimes. So again, look at the lending platform and then look at the specific sites and maybe even go and see them. You do need to do due diligence. You can't just throw your money at it and hope for the best. And we have a due diligence download guide, which I'm sure my colleague from Property Forum, Kelly, will post in the comments. Please, Kelly, if you're listening and haven't fallen asleep listening to me and Lucy waffle on. She's heard a few webinars from us, of course. But if you could post a link for the due diligence download guide on there, that would be most helpful. I'll pull that up on screen. And we've written, and look, Kelly, you're so unbelievably amazing. She's posted it straight away in there. That's come up on screen. So it's on my own website, actually, nicholaswoolwork.com. It's probably in the header bar there under businesses, but developer, loan note investments. And, you know, like Lucy's just described, we go through describing the kind of things you should be looking for when you're looking to invest in any one of these alternative finance products, direct lending, private finance. And, you know, whether if you're looking to invest into them, it gives you the checklist. If you're looking to attract investors into your product, these are the kind of things you need to be thinking about. So whether you're looking to invest in a product or use the product for gaining inward investment, that's a useful guide to show you some of the things you should be doing and preparing yourself for as you're kind of preparing for investors. If anyone wants any mentorship on preparing themselves for private investors and how to gain private investors, how to set your business structure up for private investors, the various legal documentation required, we use a loan note system, but there's lots of other alternatives. You can use first charges, second charges, equity, mezzanine lending, loan notes, property full-on bonds, which are regulated, much more financial overhead to get those up and running, much more work and expense to set them up, but they can attract a lower rate of interest from the investor, which means you can earn more money, but that's counteracted by the cost of running them. So go ahead and download that developer loan note document from there. And also on my site, we've got our loan notes on there. So if anyone is out there interested in looking to invest, we would love to work with you as investors, of course. So jump onto there and we'll talk to you further, show you around some of the sites. I want to quickly bring up a slide here, if I may, which is our current structure. So just to describe our structure on here, I'm going to whack in. Oh no, I've done your intro slide there. Sorry, Lucy, you can't see that. I've just put your intro slide up randomly. So this is our company, Red Brick Capital. This is our development firm, and we essentially have a sort of management company above that runs on the day-to-day business. And then below it are all the SPVs that we set up. And bear in mind, this isn't necessarily for everyone. You know, this is you know, potentially a structure for continued investment. First and foremost, it's for reinvesting a lot of your money. So if the SPV was sold, it whacks up, the cash reflows back into Red Brick Capital and can be re-lent down to SPV2 and so on and so forth. And that's how we do all of our sites. I think it's important to get your own accounting advice. This is not accounting advice I'm giving you. I'm not a qualified accountant. I do not know your personal circumstances. So if anyone's out there, you know, looking into this kind of product, it's really important that we maybe do a mentorship session to help you formulate your business goals. And then we would take that, you know, with some theoretical potential structures and, you know, then take those to a qualified accountant. And we have great accountants we work with. I work with Tony Gimple on that. And you'll know Tony from Property Summits again. So log on next Wednesday. You'll meet Tony and the team there. And he's the guy that I trust with this kind of stuff going forward. So I'm just going to go through our structure, if you don't mind, Lucy. Sorry to keep you, but I'll give a couple of minutes on this and we'll get back to some good questions. So the Red Brick structure, again, it's important that the low note investors come in at that Red Brick Capital level. And what that means is that company is a very, very clean company. All it does is lend money to and from the SPVs. And that's critical because it means that you can have, you know, really clean company, really auditable, very clean to see the audit trail, and it's, you know, really self-managing. The SPVs then do all the development work. That development's done. It's either refinanced and sold, and when it's refinanced or sold, the investor's money flows back up to Red Brick Capital and may sit as cash. As you can see, one of those boxes there is a cash box, and it'll only sit there temporarily as cash in a client account, ready to be relent on the next investor, on the next investment. Now, the beauty of this is that it protects the investor's money by giving them security over all of the SPVs. So if we've got several sites undergo, the investor's risk is really kept to a minimum because it's spread across these. You know, the amount of deals I see where you're investing in one deal, and that, you know, going back to what I said earlier, that sometimes concerns me because, you know, you are putting all your eggs in one developer's basket, not only one developer, one developer's site's basket. Whereas with our structure, we wanted to put all our eggs in that basket because we're investors ourselves. We want to give something that's super security, super high security for investors. It's not without risk, of course. Any development has risk, but in this scenario, we've got multiple developments. So even if one went completely wrong, there should be enough equity in all the others, and there will be enough equity in all the others to cover investors' funds. And we only loan, another caveat is we only loan up to 80% of the GDV of the sites. So, you're not going to lose all your money in this kind of scheme, this kind of setup. And ultimately, this structure is very robust for investors and reduces the risk for that portfolio risk, I like to call it. And then it comes down to the developer and who they are and what they do. And I think it's critical that people, look into that kind of stuff. I'll show anyone that wants to spend the time with me my asset and liability sheet. I'll take you around sites. I'll show you everything we do. I'm not one of these, people out there asking for people's money and not giving you the best possible security I can for it. So that's critical. I guess, what's important then is that you can leverage these SPVs with senior debt, and that's where Lucy comes in. So, SPV1, let's say our site in Newbury or our site in Reading, we've just done one in Reading, we might have leveraged that either short term with private investors or we might have leveraged it with development finance with Lucy, and, we can then use our loan note as a bit more sort of an equity piece, so it makes the blended interest rate quite reasonable. So, I'd have our high interest rate investors, often double-digit returns, cracking returns for investors. But we blend that with, highly affordable development finance and land loans when we purchase the property. And that blended interest rate makes it very affordable for us. A lot of people ask us, how can we afford to pay such high returns? And that's the reason, is we blend the money with cheaper development finance to bring the overall interest rate down to an affordable level to make the developments profitable. Investors want us to be profitable because that gives their money security. I think if you're looking to bring investors on, a lot of people think, oh God, I'm giving you a rate of return, but why do they want to lend me money? Why don't they do it themselves? And there's lots of reasons for that. I mean, they would do it themselves if they had the time or the inclination or the expertise. But ultimately, you can't second guess what people want to do, and lending is a very easy way to make good money, provided you pick the right investments, obviously. And that's critical. You can, lose money. Capital is at risk with all sorts of investments. But yeah, if you want to attract investors, it's about explaining that you do make money and not being shy of the fact you make sometimes really good money, because that gives security to their money. That goes back in the pot, back into the structure, and ultimately protects their investment further as you build your business and become more solid and secure and invest worthy and build more sites. If you use a structure like this, it improves the site security for investors as they go. So that's a little overview, a mini presentation, if you will. I'll bring you back in, Lucy. Thanks for your patience there. I guess let's move on to some questions here. I'm not getting many questions in here about private lending, guys. So if anyone's interested in private lending and how to blend that with traditional finance, ask those questions away. Adam asked, are crowd lords similar to crowd property? Yes, they are very similar. Crowd Property is a very good company as well, run by founder of Simon Zutshi, very experienced chap, good friends with Simon. He does a great thing. We've been on a couple of the TV shows on Property TV. We did an elevator show on there. New series of Property Elevator, by the way, is coming online, I think in September. We're doing first filming date in August, so look out for that on Property TV on Sky. I think back to some questions here. So I guess this is interesting. What makes a JV or loan note attractive or considered a good investment? What's your experience of JVs, Lucy? I guess you get some finance applications where the clients are JVs, aren't they? What effect does that have?
A lot of people are JVs. So you're a lot more often than not find partnerships, people who have multiple partnerships. So we might have one client who is our kind of the link between them all, but they may have 4 or 5 different JV partnerships because those different partners may be looking for different things. So it might be different appetite to risk, it might be different levels of capital to invest, and it works well because it means that you're sharing the risk. It means that you're sharing the equity requirement. It means that depending on how the JV is structured, but if both partners are active in the partnership, it means that you've kind of got two heads, which are often better than one. So I think there's a huge benefit to JVs and partnerships, and it's something that we see all the time. But we're not involved. We tend to get people that come to us at the point that they've got that JV agreement, rather than coming to us looking for JV partners. Because normally by the time they come for the debt, they've kind of got that in place in the background. Maybe they've even sourced a property. Sometimes they have, sometimes they haven't. So usually we see it once that partnership's formed.
That's good. And what do you see as the kind of partnerships? Is there someone putting in the sweat equity, someone putting in the majority of the funds, or what sort of examples have you seen? I guess you get into a fair bit of detail, don't you?
Yeah, we do. We get some where you'll have the guy with all the experience and none of the capital, and then they've got the investor with none of the experience and all of the capital. So that's one structure. Then you see some who have been in partnership for many, many years. They've both got equal experience, equal cash, and they want to do deals together because it works well. It may be that one's quite good on the construction side, one's better at finding the deals, better at the kind of sales at the back end. Somebody might have a kind of better back office structure around finance and putting together all the packs that are needed. So it's a real variety, and I think usually it's done through SPVs. That's how most people favour. They'll just set up a new clean SPV. You've got some partnerships whereby they only work with each other, so they might have a group company and all of the SPVs are spin-offs and subsidiaries of that group. So pretty varied in our experience.
Yeah, no, it's good. I mean, that's what I love about property. It's so creative, and it's like deal making and building relationships. It's, property's like any other business, isn't it? It's a people business, and JVs and relationships. I've got a business partner in Red Brick, Chris, who we've been working with the whole time and building up the majority of our portfolio there. And that's the beauty of it. I'm doing a business with one of my best friends. It's fantastic. And you can build some great relationships both personally and in business through that. And if it doesn't go well, on the flip side, there are contracts to protect you, and there are deals to finish and move on, because it's quite transactional, isn't it, property? Yeah. You can kind of finish up and that's our last deal, let's just knock it on the head and sell them and move on, or keep them. And management shouldn't be too erroneous. So even if a relationship breaks down, it's not usually too difficult to move on, knock that deal on the head and move on to the next one. Adam Howard, thank you for all the questions, by the way, Adam. We appreciate your input. Keep them coming. If you want some more questions answered, please drop in. Don't forget to subscribe to the YouTube channel. If you guys are watching at home on YouTube or on Facebook, make sure you subscribe or like the pages. Hit the bell icon, because we want you to be notified when we do these awesome free webinars, picking our brains and delving far deeper into property finance than anyone has ever delved before. I'm not a Star Trek fan, by the way. I don't know where that came from. It's a bit weird. Adam Howarth asks, again, Adam, where can I find or reach the private investor funds? Well, if I told you that, Adam, I wouldn't be able to charge for my mentorship now, would I? That's the key. Joking aside, there's lots of ways you can find investment funds. But I think the best way to find them is be fully prepared in the first place. And we started this segment, Lucy and I, talking about how to attract and present yourself as a viable investment. And I think it's critical to start off with the right websites, the right marketing, the right branding, personal branding, good LinkedIn profiles, showcasing what you've done and what you can do. If you're starting out, and I notice there's a question here from Nikki Kerr. She says, do private lenders want to see that you've done this before in a professional capacity? Well, not all of them is the answer to that. If you have it, yes, of course, it makes your case stronger. As you grow and you get bigger and more successful, and you can demonstrate a better track record and you have more security to give. In Red Brick, we're building up a portfolio. Each site we do that stays in the group just adds to the security. So in theory and in practice, we're adding to the security for our investors each and every development site that we keep, which is fantastic. But if you've never done it before in a professional capacity, you've got to start somewhere. Everyone's got to start somewhere. It's certainly easier once you've done a few deals and can prove you can actually do deals and do developments and do conversions and whatever your product is. But ultimately, it is key that you can demonstrate that. What's really important in property, though, as well, isn't it, is the deal. And this goes for any kind of lending, doesn't it, Lucy? Is the deal itself. If you've got a cracking deal that is a no-brainer deal, loads of income, not too difficult development work, it's going to make a ton of money. You've bought it super cheap, below market value. You've bitten someone's arm off at an auction and got something 50% below market value. The deal's going to do the talking for you for the majority of this, as long as you can show that you know what you're doing. Maybe you've got a good, this is where building a good power team works out, working with people like myself and Lucy to help you not make as many mistakes and get a lot of it right, demonstrating that to your investor as your extended power team. We can do that. When I mentor people, I am happy to go on their website as a consultant or maybe a non-exec director in some scenarios, to help out build their profile and build their track record because I'm involved with them. But also it's, really important that, the deal is presented in that right light. So you've got this cracking deal, present it properly, get your marketing and branding right, and ultimately make sure you give good security. In the early days, you might have to give more security. You might have to give away, first charge only, and you might have to do it on a pure first charge. You might not be able to use loan notes initially, but really depends on personal circumstances, doesn't it, Lucy? I mean, a bank of mum and dad's a good starting place for many people.
Yeah, I think if you can borrow from family and people who kind of know you to be able to trust you and understand your integrity better than somebody that you've just met, then certainly that's a good stepping stone. And I think my advice would be not always to get too hung up on having to start too big, because like you said, Nick, you started by renting out a room in your house, and I think there's no shame in demonstrating your track record by doing a few smaller deals to be able to give people the confidence that you can deliver what you said you were going to deliver on time and on budget. So I think don't be worried about having to hit the lights out with the biggest project around. Just make sure that you're not biting off more than you can chew, and then people will respect you for having taken the time to demonstrate that professionally.
Yeah, no, very good advice. Get to a couple of quick questions on JVs here. I'm trying to pull you in where I can, Lucy. I know it's a bit specific, and it's about how we blend these products together, isn't it, often that makes the success. It's not about one or the other. It's about the blending of products and the blending of experience to kind of, pull the deal together in the best possible way to make the most money, which is good for you as a developer, and it's good for the investor because they're more secure if you're making money. Ultimately, you don't want to be on the limit. You don't want to be there kind of marginal on a deal because that's risky, and investors don't want risk, and you don't want to put yourself at risk either. So we have got a question here. Simon Paul has asked how to set up a loan note structure right away and get a small number of investors and do it properly. Well, right away sounds like you want to do it in a rush. I don't recommend that at all. But no, ultimately, I would say, and I'm not being biased here, but book a mentorship session with me. I'm not pitching myself because I've got loan note documents. I can put you in touch with solicitors that are familiar with them. I can show you how to set yourself up and do it. I can give you some advice on the company structure that you should take forward to an accountant and advisors to get professionally set up. And then ultimately with the marketing and the setup and the brand, you can be away. We spent, probably over £20,000 on the advice to get the documentation and the advice together to make it compliant. And I would stress anyone interested in investing with us and the loan note structure, it is only open to sophisticated and high net worth investors. And the exact criteria of those can be found on the World Wide Web. Type in sophisticated or high net worth investors. You have to self-certify for that to be able to download the brochure on our website on redbrickwealth.com. So yeah, I've just put that up on screen there. So pop along there if you are an investor interested in investing. If you want to learn about how to take that investment, I can show you how through the mentorship stuff. Now, let's get on to some more questions. I'm trying to bring Lucy in here. Let's find something that we can do and talk about here. So opportunities for private finance, for investors to invest into developers' finance in today's market, and about protecting your investment. And I guess this goes for all sorts of finance options, Lucy. Is the market right at the moment for developer finance products? In terms of, should people wait? And we covered this a little bit earlier, but should people wait a few months? Should people dive into a full-on development at the moment, do you think? Or should they wait a few months? What's your kind of opinion on the timing of taking on something a bit more contentious as a development?
I think that you shouldn't let the tail wag the dog. So if you find the right deal, I wouldn't hold fire because of what may or may not be. I think you have to assess it prudently. So if anything has got low margin in it, then you shouldn't be doing it anyway. If it's got low margin, you have to think what would happen if the end values were to swing by 5 or 10%. Do you still come out of that okay? Because ultimately you need to make sure that you will make money even if the margin's squeezed. You need to make sure that you've sensitized it against market swings. I think that's probably rule number one, isn't it, Nick? So
definitely.
When it comes
there's never any time like the present either, is there, Lucy? Because it might just get better and better, and actually now could be a really good buying opportunity to do
that
this
was my next point. Yeah, so okay, you might have to put 5% more equity in, but really you have to be reasonable with where the market is and have reasonable expectations. And I think if you find a really good deal which has got a huge amount of profit in it, if you're putting every last pound you've got into that deal, again, you're overstretching yourself. So you need to have a think about how thin you'll be spreading yourself by putting the capital you've got in. And if you need to put in an extra 5% and you can afford to do it and the deal stacks up, why wait? It's not particularly more expensive to do it now. Some lenders have priced up a little bit, but not enough to really change the profile of a good deal.
No, okay. No, that makes absolute sense. A couple of guys having to jump off the webinar. Thanks, Adam, for your input. Thank you, Andrew, for your input. Really appreciate it. Just keep those questions coming. We're going to draw to a close in the next few minutes. Got a few more pre-submitted questions, Lucy, let's run through. Well, this is a really good question, actually, and I don't think either of us can answer it at the moment, but we sort of can. Is there a platform where developers and finders can connect and discuss possible JV products? Are there any that you're aware of? I mean, obviously, I'm going to say Property Forum. It's an online forum. It's the largest international chat forum. Jump on there and ask. There's people on there all the time chatting, and you never know who's watching and listening and going to pick up on your thread. But have you found any good tools out there or any good networking events? I mean, I guess all the usual suspects, right, Lucy? Networking events.
Yeah.
Mortgage-specific finance ones we don't know about that you could recommend, or?
No, not really. I think that part of the finance world is so bespoke. People have tried to harness technology, but even where you have harnessed technology, there's normally people sitting behind it because everyone's circumstances are so different. So on the debt side, really, I think you just need to talk to an expert, whether that be us or someone else. You need to make sure that the people you're talking to are properly qualified to answer your questions. And then really they should be able to connect you with the right funding opportunities. When it comes to JV partnerships and kind of deal forums, I suppose, like you say, going on to the forum, Nick's forum and others and networking events. But to my knowledge, I don't know any pieces of technology where it matches projects and investors and JVs, etc. But I don't know. There's a lot of things out there that we don't all know about. So perhaps there are.
And I think it's about the key is you'll find investors when you present yourself correctly and you've got a structure that can be investable in. It's not just about you or the property deal. It's about the structure of security you put in place, the offering you put out there, and the way you present yourself, and going out there and being very open and transparent and highly ethical to go and show people what you can do. And it's like any business. It's about how you show what you can do. You've got to be able to do it in the first place. You'll be confident you can do it in the first place, but then it turns into being open and transparent, doesn't it, really? And finance is a tricky market, and you want to be able to be extremely ethical to demonstrate that in a marketplace in the property world where there are some not ethical operators, unfortunately. And I guess that's why we started Property Forum so long ago, and we're very picky with who we work with. And we obviously work with Lucy on the finance side because there's so many dodgy people out there. I've had a broker before do a deal for me, promise me a sort of cashback scenario, this was a few years ago, and then disappear off with my money having got one deal through. I mean, that's the kind of people that are out there. So beware, people, beware. I think we're going to kind of wrap it up. To be honest, there is a good forum on the Property Forum itself. There is the general property investment discussion. If you go onto propertyforum.com/forum, you'll see it there. That's the full link I've just posted up, and that general discussion hopefully better pick up if anyone's listening, investors or developers, hands-on buy-to-let people, in the chat, jump on there. Hopefully you might be able to speak to some people. So yeah, I guess really just kind of want to wrap it up, to be honest. I'm just looking down the list of questions here. Not a huge amount to cover, really. I guess, Lucy, can I just, finish up by asking you to do a quick, heads up of the kind of people you can help, who you think you can help with the call. We've got the link, book a call with Lucy, along the bottom of the screen, but ultimately, who can you help, Lucy? And what's your product?
Yeah, so it's quite wide ranging. We deal with different levels of experience. So we have a huge pool of professional landlords, professional developers who have done many, many units, do large schemes. But then conversely, we also have helped many people in their very early days in their property career. So whether it be a small buy-to-let, your first buy-to-let purchase, we have a team of people that will look at the more mainstream buy-to-let market. We can help people that are looking to raise equity on properties that they own to invest. So it could be that you want to pull some money out of your home. We've got people who can run through the advice process on that to see if it's suitable and whether there's a product out there for you. We will do the more complex end of the buy-to-let market. So HMOs, large multi-units, semi-commercial, student housing, student accommodation. We do mortgages for overseas borrowers, expat foreign nationals. So it's pretty wide reaching. I would say development finance and bridging finance is a big part of what we do. We will help people at various stages of the journey. So you may be buying a piece of land, you might be buying a dilapidated property that you need to convert. We will assist with the purchase, we will assist with the renovation finance, and then if you decide to keep it in your portfolio, we can help you to retain that as well. So we try and take a real sort of solutions-based approach to how we deal with people. You tell us what it is you're looking for, and we will kind of run through our catalogue of products to work out what might suit you the best. And we can be, that can move. So we can talk to you initially and you might think, well, I like part of what you've suggested, but perhaps I want to move on to something slightly different. So we're quite flexible in our approach, and I would say the best thing to do is just pick up the phone, get in touch, and we can have a good chat about what you're looking to do and see where we might be able to assist.
Okay, well, I really appreciate that. I think demonstrates the wide breadth of knowledge and skills Vantage Finance have, and as I've said all through this webinar, and the reason we work with you guys continually is the depth of knowledge and that ability to have the foresight, looking at the best possible products on the market. I've had a good example recently where another broker suggested something, didn't they, 75%, and we quickly broke that down that was very unlikely to be achievable because they hadn't looked at kind of phase 3 of the detail of that site, and that could have wrecked a whole application. So it's been really great to have you on the show, Lucy. Thank you so much. It's been an absolute pleasure.
Thank you.
Huge amount of knowledge. Yeah, it's been great fun, and thank you for everyone's questions. Really appreciate everyone's questions. If everyone remaining watching, we still got 40 odd people watching still. Make sure you've subscribed. Please subscribe. You don't want to miss anything. We've got some great content. You can always delete us if we're talking rubbish later, which I assure you will try not to. well, not too much anyway. We'll keep the good quality information coming, but you want to get subscribed or liking the pages if you're watching in a new group, so that you can get notifications when things come online. Don't forget to jump on propertyforum.com, and lots of free information there, loads of free ebooks. I've written probably, I don't know, 8 to 10 ebooks at the moment on all different types of property strategies. Lucy and I have co-written a book on property finance, which a number of you might have seen as part of the registration process. That's a really useful tool. Don't forget to jump onto Amazon, download the Investing in International Real Estate for Dummies book. And obviously, in case you hadn't been listening, I do mentorship. And that's where it's just a practical guide. You know, if you've been on courses, you've done the education, you've read a load of ebooks, you've done all that stuff, and you're kind of struggling to get going and just get the final piece of the puzzle together, taking real practical steps, analysing deals, expert sourcing tips, and working together hands-on to get you going, you know, get you out of that analysis paralysis stage and actually doing deals and getting ready to do deals. That's where I can help you if you're interested. So yeah, it's been a super show. Thank you ever so much for joining us. Hope to join you. Hope you'll join us, in fact, next time at the Property Forum TV chat show. Goodbye for now.